Governor.
Welcome everybody to Lurking in the Deep. We're excited for our panel of industry leaders today who are going to be discussing with everybody some insights about how emerging challenges with the Paycheck Protection Program, how they've dealt with those, and as well as how KYC automation has helped these particular leaders deal with these challenges. So getting right into our panel today, my name is Tiffany Chesnos. I happen to have had a variety of different leadership roles in financial institutions. Most recently was the vice president of a regulatory tech company, and now I am doing some financial crimes advisory lead work for Genpact Risk Canvas. So today I wanted to have our panelists introduce themselves. And when you introduce yourselves, to make it more fun, since we are lurking in the deep today, we want to hear about your favorite ocean-themed movie. So I'll start off with that and say that my favorite ocean-themed movie happens to be Finding Dory. And my husband did a little bit of animation on that movie, and that's why it happens to be my favorite. He didn't discover any sort of PPP problems while animating, but it's a good movie. Okay, Quinn, would you like to introduce yourself next?
Absolutely. Thanks, Tiffany. And thank you all for joining. We're excited. We think we have some great content to go over today. My name is Quinn Hout. I lead Global Financial Crimes Risk Management Advisory for Genpact. I have been with Genpact for about 2 years now. Prior to Genpact, going back about 5 or 6 years ago, I led global financial crime advisory for Booz Allen Hamilton. And if you know Booz Allen, we did a lot of work with US regulators, intelligence community, DoD, and a lot with global banks to address the money laundering and fraud threat. And after running that for Booz Allen for a number of years, I was asked to kind of split off of Booz Allen and form a startup company called Risk Canvas. And Risk Canvas was really, focused on solving the financial crime problem and the threat in a unique way, in using technology, using innovation. Many of the discoveries that we had serving the U.S. government intelligence community, taking advantage of some of those technologies and techniques, but doing it all for banks and payment companies and tech fins and fintechs and so forth. And so we are pretty focused on innovation. We built this Risk Canvas product that does transaction monitoring, case management, KYC, et cetera. And we started to go out and sell it to many of the world's largest financial institutions. And about 2 years ago, Risk Canvas, a subsidiary of Booz Allen, was acquired by Genpact. And now we are plugged into Genpact's global financial crimes business. And so we're really excited to be where we are, and it's really accelerated our growth at Risk Canvas. And we continue to do the same thing we did before, solve really tough problems through innovative technology, analytics, and solutions. I continue to lead a global advisory team at Genpact and with Risk Canvas, where we provide strategic consulting services to a lot of the top banks and non-banks. To your question about favorite ocean movies, I think I'm gonna have to go old school on this one, Tiffany. I'll probably go to The Abyss by James Cameron. And that was a movie when I grew up that kind of gave me the heebie-jeebies about kind of being thousands of feet under the ocean and kind of being stranded down there. And I think there was so much about that movie that was exciting and scary and innovative from a filmmaking perspective.
Okay, Stephen.
All right, yeah, no, thank you, Tiffany. Stephen Dietz. I'm a financial crimes advisory leader with Risk Canvas and Genpact. And I've been with the company since January of this year. I've got a little over 13 years experience in the AML space. Prior to Genpact, I worked with a Big Four advisory firm in their AML advisory practice. as well as served as a chief AML officer for a regional bank in the Southeast. And prior to that as well, worked within an AMO program in a large regional bank over on the West. So, I've got virtually experience in virtually every aspect of an AMO program on both governance and operations sectors. As it relates to my favorite ocean-related movie, I'm just gonna have to go with Pirates of the Caribbean, and I don't have an interesting backstory as to why, similar to you or Quinn for your movies, but it's just one that interested me, and I saw it, when I saw it and enjoyed the thematics of it, or theatrics of it.
Thanks, Stephen. And John?
Hello, everybody. My name is John Colantoni. I'm the Chief Risk Officer of Sonabank. As you can probably tell from my picture, my very professional picture, I'm a big Red Sox fan. And in that picture, I happen to be lurking in Camden Yards, watching my Red Sox play. My background, I spent 24 years at FDIC here in Washington, D.C. And then I decided to get a real job, and I went into banking. And I've been at Sonabank now for 7 years. We're a $3 billion bank, primarily located in Washington, D.C. metro area in the state of Virginia. Our focus is really on heretofore has been on commercial loans. And so I've been with them, like I said, about 7 years. I used to be the head of internal audit for the bank until earlier this year. And my favorite movie is going to go with Castaway. If you recall that story, it's about an executive stuck on a deserted island trying to survive. And in the risk management world these days, I can really relate to that.
I hear you, John. I hear you. All right, so at the end of this presentation, we're going to have some questions and we'll provide answers as well, but feel free to chat with your questions as they come up. And if I can find a space between our various guests, then I'll go ahead and ask the questions while they're speaking, but feel free to type them out and I'll go through those at the end as well. So to introduce the topic today, high level, what we're going to be talking about is the Paycheck Protection Program loans from a financial institution perspective, a little bit about the background of how those loans came to be, that emergency relief program, more about the fraud that has been detected since we've been processing those loans, and actually super excited to hear about John and some of the experiences he's had with the fraud that he's seen come out of those loans. Then we're going to dive in a little bit into the tech application and some research that Quinn did, some really meaningful insights that he's collected from the PPP. And then we'll go over, he's got a dashboard and some insights, very interesting insights to show. And then, like I said before, we'll have Q&A at the end. All right, so with the PPP loans, when they were first announced and issued, you can imagine when people heard of money that you may not have to pay back, it was kind of like Jaws, right? A feeding frenzy. We'll keep that theme with ocean. There were so many people from all different sorts of businesses trying to throw their hat in the ring for these loans. And that was all during the time of unprecedented unemployment rates. So you've got this seemingly free money at a very dire need for money, a very time of dire need for money. And then you've got these small businesses that are struggling immensely to maintain liquidity. So the financial institutions that agreed to process these really, really struggled to meet the demand of the volume of applicants, and then past that to start processing these loans in a quick, efficient manner. So how, with that high volume, were financial institutions expected to maintain regulatory compliance? And at the beginning of these loans, the federal government was, they weren't clear about everything because a lot of guidance came out, but they were they did make a statement that there wouldn't be the burden on the banks for oversight of these loans. That still doesn't mean that compliance doesn't have to take place. So there was kind of this in between, what do we do? How far do we go? The burden's not on us, but we can't ignore our compliance initiatives either. So relaxed expectations by regulators led to a bunch of misinterpretations of the requirements. And then of course, there's this increased vulnerability because it's the statements publicly out there that the burden is not going to be on financial institutions for oversight. You can imagine for a bad actor, that's just dollar signs all over the place. And then finally, the customer experience. So this is a new program. It's a one-time, very novel situation. The questions that customers had were, a lot of them, financial institutions weren't even able to answer because they didn't know and had the same questions. So that led to even higher processing times, and customer satisfaction definitely went down because of this program in a lot of institutions. And then of course, there's the issue of loss of brand equity. So let's get right into the background of how these loans came to be. And Stephen, do you want to speak to this?
Yes, thank you, Tiffany. So I think we all kind of know, at a high level what caused, Congress to pass the CARES Act and provide, this payment protection program to all the small businesses around the U.S. From a financial perspective, but more specifically, just talking a little bit about the background related to due diligence waivers and potential traps. If you think about it, we all at all the institutions, understand the FinCEN due diligence requirements, and essentially, one of the main requirements as it relates to the PPP program was that we follow normal due diligence procedures. And that's the theme, that ringing throughout the FAQs and whatnot. Specifically related to new customers, FinCEN updated their FAQs, at the second round of availability of funds, specifically related to what needed to be obtained from a beneficial ownership perspective, related to name, title, ownership percentage, TIN, address, date of birth, typical things that we would, be gathering for normal beneficial ownership due diligence. And then also required further verification, in accordance with policy. From a waiver perspective, related to the PPP program, the waiver came in such that for existing customers, there was no requirement to obtain beneficial ownership or, even re-verify existing beneficial ownership. And if an institution did not already have beneficial ownership information on an existing customer, there was no requirement to go back and obtain that information. Now here's where the traps come in. And that's kind of leading into, this next discussion point in terms of the qualifier that FinCEN provided as it relates to that waiver is unless otherwise required by your policy. So I would say, just from my perspective and what I've seen, that's one of the biggest glaring traps, as it relates to the PPP program from a due diligence perspective, is, if you have some sort of risk-based approach within your policy, where it requires you to go in and you've identified certain events, right, per FinCEN's guidance or not their guidance, but the CDD final rule. You've identified those events, and one of those events could be, classified as or where a PPP loan extension could be classified as one of those events. Then there's a potential trap there, and not having updated or even obtained a beneficial ownership. And then the other trap relates to, the release of burden as it relates to the fraudulent loans that occur through this program. I think the government, was very aware that there would be an increased loan fraud rate through this program. That left banks in between a rock and a hard place in some regard, because I think there was a definitely, good faith effort for all the institutions out there extending these PPP loans to legitimately help out their customer base and those individuals around the nation struggling, through this hard time to keep their businesses afloat. There were very good intentions with it. Naturally, as Tiffany, as you explained, in these programs, they're also abused. Related to the relief, institutions in some regard are not going to have to eat any sort of fraudulent loan. However, where I'm getting at with this trap is that is presuming adequate due diligence was performed in the first place. So I could foresee scenarios where regulators coming into the bank, or even from a law enforcement perspective, related to these fraudulent loans, where a bank didn't even follow its own due diligence procedures, and then the government comes back, or regulatory agency comes back, or law enforcement, or whomever, just says, well, essentially, we were able to prove that you didn't follow your own due diligence procedures, and you should have kind of been in that position to identify this loan, and you extended it anyway. Therefore, we're not going to provide that relief. So that is another potential trap that I could see happening, and scenario that I could see happening.
Okay. I was going to ask you a question about that. You're talking so there's less of a burden on financial institutions to have oversight of these loans. What do you think, however, when the federal government does start to dig in, maybe there is a high rate of fraud with these loans at a particular institution, how do you think that's going to impact their view of that financial institution's compliance processes as a whole? Is it going to be a red flag if one institution has more fraud than another?
I would say most definitely, because the regulatory agencies have that purview into that data, and have the ability to compare, loan fraud rates among various institutions that they regulate. Specifically related to how, the implications of the overall due diligence program. I think a bank's overall due diligence policies, procedures, and processes could be implicated. If the regulatory agencies come in and start, reviewing the loans. I know of a number of banks already where the FDIC has come in and has specifically asked to see their list of PPP loans and wanting to review files and the processes behind extending those loans. Can
I interject, Steven?
Yeah, go ahead.
I mean, I think what you said is absolutely key a minute ago, and that is when an institution becomes involved, or some of these PPP loans underneath an institution are implicated in fraud, like some of the examples that we're going to talk about, it will naturally, both from regulators and law enforcement and just the public eye, force a spotlight on that institution. Just look at, some of the headlines over the last week with some of the big fraud cases, PPP fraud cases. It's kind of put that into the public eye. I think it's going to happen more with the FinCEN files and the more attention on AML. Now, when that spotlight comes down on your institution, it really, you know, how comfortable, how confident are you that your due diligence procedures that you have had in place for a number of years, right, that have always kind of been in place, that you did initial KYC on these PPP loans, you know, even if they're existing customers have been with the bank for a long time, how confident are you that you did it right that first time when you onboarded that customer? And how confident are you that you shouldn't have done additional due diligence at the time of the loan because it's a new product type? And so I think that's kind of the forcing function for why institutions should think about doing this kind of double check, right? This kind of verification, because most compliance officers, when asked that question, would say, well, look, I'm a little bit confident, right? I'm pretty confident. That's why we have lines of defense. That's why we have audit. But, you know, it's worth kind of doing that extra kind of double check specifically on these PPP loans, because they're going to draw more attention related to the fraud risk, related to the compliance risk, related to the reputational risk that is bound to come when things go wrong.
Yeah,
Yeah,
great insights,
exactly.
both of you. Keep the bootstraps tight. Don't let down your guard just because there's seemingly this gift to do so.
Correct.
Keep the bootstraps tight. Make sure your program is just as tight on these as it is with any other type of compliance issue. So Stephen, do you want to talk about some of the examples with the Paycheck Protection Program of fraud and AML that we've seen?
Yeah, no, absolutely. So, you know, to kind of extend into that discussion and provide some real life examples here in terms of what we've seen. You know, you can see a few examples here related to, you know, PPP loans, a number of, you know, these examples as well being in the news. In publications. I mean, I think on LinkedIn every other day or every day I see a new one pop up, you know, a story of a fraudulent PPP loan. You know, but just to highlight a couple of them here in the interest of time, you know, one thing related to continuing that discussion of how, you know, due diligence processes or lack thereof through the PPP program could implicate further, you know, your overall due diligence policies, procedures, and processes in general is related to, you know, the additional steps of negative news screening. You know, maybe your institution does have automated negative news screening in play or in process, and that's great. Or maybe you do it manually, maybe you don't have that as a normal process, you know, through the onboarding stages. But one example, you know, we came into was an individual who had formerly, you know, been involved in providing ammunitions, and in some cases, you know, was fraudulent about his supplying of ammunitions to different countries as well as our own government. You know, just speaking of lurking in the deep, you know, think about your institution and you have an existing customer base, or even you opened up the PPP program to non-customers around the nation, just not knowing, you know, what kind of background these business owners have is important, and that's just one example, you know, that we've seen. Another one is a couple being charged with loan fraud as it relates to the PPP program, where they submitted 18 loan applications to 12 different financial institutions. And mind you, you know, one aspect of the PPP loan program is that they can only be extended to one entity. So if you have, you know, an entity that's submitted a couple of applications, or maybe you extended a couple of different loans and there's similar ownership and there's, you know, but different entities, or maybe they're the same entity, you know, just those are other things throughout this KYC double check, you know, that we could bring to light as well. Another aspect of it is the use of a shell company we saw actually a couple of different cases where individuals had utilized a shell company, in terms of ownership of their consulting practice. And they submitted falsified articles of incorporation or business documentation as it relates to their consulting practice, as well as false invoices for having provided services. So just a few examples to highlight there. John, I don't know if you want to add any color here or flavor, just from a chief risk officer perspective, to that. But I think it's definitely not revelatory that the PPP program is rife with fraud.
Yeah, and I would just add, this was a program, of course, where we really focused on preventing these loans happening to bad actors. And, and I think we did a really good job, but some got through. I think that last one with the 18 different applications to 12 different, we were in part of that, but we caught it in time. And a couple was arrested. I think they were on their way to Poland on a one-way ticket. If that's the same one, and we worked with a couple of other banks, and we were able to get those funds back. So it's been prevented. I think we prevented a lot from happening. We stopped a lot of these applications came in, and we were able to stop them. But a few got through. But there's the detective side, and we're working a lot of those, and we've caught a few. We've caught a few. The bank hasn't lost any money. We don't anticipate losing any money either, because we did what I would call satisfactory due diligence up front. So
yeah, and what you say there, John, is rather important in continuing that discussion point from what Tiffany asked, in terms of how this process could implicate overall due diligence, and I think you kind of hit it right there, right? I mean, we could never stop fraud completely. We can never prevent money laundering. We can never prevent financial crime from happening or getting through it. It does happen, right? The point there being is, if a bank has, not to be cliche about it, that robust risk-based due diligence program and process in place, when those loans do get through, we're able to identify it and then take the appropriate steps to get some relief there and not lose those funds. And also just furthering that point and driving that home of due diligence, when it doesn't necessarily just mean and stop at that account opening process, right? I know a number of institutions that I've spoken to that have some form of remediation plan, because let's not forget too, right? The first batch of funds, I think, was completely depleted within 2 weeks of being released to the nation. So that's a lot of funds, a lot of loans that are being issued rather quickly. So having some form of remediation and maybe doesn't even need to be referred to as remediation, but some form of double check, to use our term here, in order to go and identify these matters rather quickly, places a bank in the best position possible in order to have a good faith effort of knowing and understanding who these businesses are and to whom they lent the money, from a regulatory perspective. Okay. So moving on, Tiffany, to the next slide here. Yeah. And with this, I'll actually turn some time over to John, kind of let him, talk about his institution and talk about what we did and what were the results of that.
Okay, thanks, Stephen. Yeah, like I mentioned before, we're about $3 billion in assets, community bank in the Virginia, Maryland area. And so when the crisis hit early on, we saw that, you know, we just don't have the manpower to really get into this. So the first go around that you mentioned, we did very few loans. I think about 140 total loans, maybe 60, $70 million before the funds were depleted in a couple of weeks. And so we huddled back and we thought, you know, by then our customers the phone was ringing off the hook. Even though we're in the Washington, D.C. metro area, in heavy government presence and a lot of government contractors, we didn't have a lot of that in our portfolio. So these were people that were hurting. We have a fairly large portfolio in the hospitality industry, hotels, restaurants, even some gas stations. You know, people not commuting, they were feeling it. A couple of daycares, churches, so on. We had a very, very successful, very large limousine livery business who was doing extremely well. They had a lot of government contracts, and then when the government, you know, told the employees to work remotely, that kind of killed their shuttle bus service from in DC, and so they were hurting, and we had a lot of people coming to us. So our CEO said, we're going to be ready for it on round two. We're going to go into this, and we looked at it also not only as an opportunity to help our own customers, but to some banks didn't get into it. So we decided we were going to open it up to non-customers. And that's when, you know, I started scratching my head and getting a little nervous that, you know, I'm not sure we have the ability to do that by ourselves. So we had a lot of meetings. We started realizing we needed to bring some partners into the process. As a FDIC insured bank, and for those of you who work at banks, you know what I'm talking about. We're very heavily regulated. Every year, the Federal Reserve comes in, state of Virginia comes in, looks at us. We also, we're a preferred SBA lender. Probably every 18 months or so, SBA's coming in, they're looking at our loans. So we have a lot of regulation, and we knew we had to develop a program that ultimately would satisfy the regulators. So we looked around, and you know, we thought, how long would it take us to build this program ourselves? Well, it would have probably taken us 6 months to a year to get the proper people in, the expertise, the knowledge. You know, we have you know, maybe 8,000 to 9,000 loans on our books. We do more larger commercial loans. So we didn't have the infrastructure in place. We close 80, 90 loans a month. And so we realized we had to do something. And so if we built it ourselves, we would have missed round two. So that's when we started looking around and engaged a couple of partners, and one of the big ones was Genpact to come in to take a look. We were personally, I was very concerned with our non-customer base. As you mentioned earlier, I think our regular customers were, I didn't have as much of a concern, but still, I thought, let's bring somebody in. And so we had Genpact look at something, I think over 2,500 loans, which included some of our own customers. And that's been very helpful. And I will say, just overall, this decision, Sonabank, we made about 12 or 13 million dollars in loan fees through the PPP program. It was very helpful to the bank. We've also been able to retain some customers, some non-customers that we brought in through the PPP program that have stayed with us, that like the service, like the way we handle things. So it's been a very beneficial to the bank. You know, one of the things too, when we engage an outside vendor, we have a robust vendor management process. And so anybody that's doing work for us, that might be dealing particularly with sensitive customer information. We put them through a pretty robust VM program. And Genpact, I'll say this, was their due diligence package, the information they provided to us was really comprehensive and complete. And so we were able to go through and get satisfied really quick that that this is a customer that passes through our vendor management protocols, and that we could engage them and be comfortable engaging in them. And so that was important to us. That was important to us.
John, would you mind talking about some of the things that you did as part of this double check with the help of Risk Canvas?
Yep. Two things. We really needed the help on the non-customers. That was, like I said, that was my biggest concern. And those were run through the Risk Canvas protocols to help us prevent. We had some real-time feedback, and some of it we're still working on. The other thing it helped me on is, as we probably put some of our maybe 1,000, 1,500 of our own customers through this, and it kind of gave us some feedback into our own process. Did we miss anything? Did we? And so what we've done, we've been able to do with that is, I think the feedback we got from Genpact was, overall, I think our process is pretty good, but there's room for improvement. And so we've got our compliance people, our BSA folks, going through the book that we received on our own customer base to see, hey, did we miss anything? What can we do to shore things up to improve our process? And so it's very helpful in that regard too.
Great. So I'd like to move into the next piece of this discussion. A little bit about the tech application of this. Stephen, if you want to address this slide.
Yeah, no, so, naturally with coming in and doing, a review like this of KYC due diligence, we wanted to be as efficient as possible. So, we have a technology called Risk Canvas, to which we brought to the table, and as it relates to, this particular program, and the KYC double check reviews that we performed. And essentially we utilized it to facilitate the review process. The technology includes dashboarding, reporting capabilities, for workflow and productivity management. So, if you think about it, our engagement manager utilized our tool in dashboarding and reporting to be able to effectively manage the progress of the reviews and whatnot. It also includes our Risk DNA technology and an approach to scoring. And specifically, within Risk Canvas, we're able to customize the Risk DNA application. Typically it would be utilized for ongoing customer risk scoring, modeling, et cetera, of your overall customer base. But in this particular instance, we very quickly configured it to essentially generate a PPP, what we're calling a PPP KYC score. So that if you think about it, it's not essentially to replace the overall customer risk score as it relates to your normal risk scoring processes, rather provide a view into an objective view into the KYC risk and regulatory risk associated with that particular PPP loan. So it does, we do utilize some attributes of what you would normally see in normal overall customer risk scoring, but there's some nuances as well related to the PPP. And the point I want to make with that as well is that, through this PPP loan process, where you do have existing customers that have obtained PPP loans, and maybe you go and perform new due diligence, or maybe you do a KYC double check or we come in and do a KYC double check. The important thing to note is in this program, banks should understand how the addition of the PPP loan or aspects of the PPP loan contribute to the overall risk score of the customer, if that makes sense. So that is an important key factor within this technology that we bring. Then it's also a case management workflow. So we utilized our workflow in order to facilitate the actual reviews of the KYC for each entity. In the KYC workflow, it includes what you would typically see in a KYC periodic refresh or even onboarding KYC review. We bring in external data sources through our entity E3 entity enrichment to automatically provide some additional inputs of data in view into the customer, as well as our UBO structure that we're able to automate. Additionally, we were able to automate aspects of the workflow just as it relates to different steps and narratives, et cetera. And as we were starting the program and through the automations that we were able to achieve and develop within this technology, we brought what would normally be a 2.5 hour KYC review down to 30 minutes or less, depending on the size of the entity and the loan structure and the complexity of it. So again, the technology brought a lot of efficiency through this process, and which allowed us to do something good for Sonabank and get through a population of 2,500 customers in a very efficient and quick period of time.
All right, I'm going to stop sharing my screen and pass this off to Quinn, who's going to talk about some of the insights that he discovered when the PPP program or PPP came out. So you should be good, Quinn.
Yeah, thanks, Tiffany. And I'll try to kind of go through quickly because I want to make sure we leave time at the end for some Q&A. But one of the things that we've been doing, in addition to helping customers like Sonabank is kind of looking at the bigger picture and looking at, the quantity of PPP loans that have been made and, speculation around, additional funds that may be coming still. And looking at, what are the trends that we can see and insights that we can pass back to our, customers. And so I published an article on LinkedIn. I'd encourage everyone to maybe go check that out because, I try to distill a lot of the learnings there in that article. But what I'll show you here is kind of a dashboard. And this dashboard is basically built on top of the SBA loan data that was published by the Small Business Association. It was only made, the data was only for loans that were, greater than $150,000. And so, it's not all of the loans. I think the majority of the loans were actually smaller, but this, gives some insights on those larger loans. I've got a couple things I'll walk through here. The first is just kind of looking at some of the demographics of the loan. And loans. And you see here, there's a total of 660,000 loans. So a lot of these PPP loans that went out. And again, this is just a portion of them. You can, as you might expect, this kind of heat map shows where most of the loans were given. And no surprise, California, Texas, New York, Florida, places with large population. I'll point out, count by loan range down here. So again, looking at the data, we have, the majority of them were in that range of 150,000 to 350,000, followed by 350 to $1 million. And then, much smaller wedges for the larger loans, and a lot fewer of those that went out. Just also a count by business type. most of these were corporations followed by LLCs and S corps. And then one of the things I thought was interesting is kind of looking at this heat map of NAICS codes, right? And as you can see, there's quite a variety of types of businesses that receive these funds. As if we were in a different setting, maybe I'd love to hear thoughts and guesses on what these larger blocks are. If you don't have your NAICS codes memorized, this largest block is for restaurants. And so the majority of these were actually restaurants, followed by doctors and dentists and folks in the medical field. And then, over here, we've got attorneys and legal professionals. So those made up some of the larger demographics that receive these loans.
So this really was a feeding frenzy, wasn't it? All the fish in the ocean?
That's right. That's right. All the fish in the ocean, every type of fish you can imagine. And as Stephen mentioned, most of them, they went out really fast, right? You see, the vast majority of these went out, of the 600,000, over 500,000 of those, 550,000 of those went out within the first month, and it really tailed off after that. The other thing I'll point out here is this kind of count by lender. And you can see that, it's really the usual suspects that you would expect: Bank of America, Wells Fargo's, TD Banks, the big institutions here up at the top. But just look how long this tail goes, and look how many institutions kind of got into providing these loans. And one of the things that I found to be really interesting was looking at, some of these smaller banks that typically, they have their typical type of customer. And John, I imagine that you've seen this with Sonabank, right? You have your kind of stereotypical type of business or size of business or location of the business. Sonabank is pretty, is popular here in Northern Virginia. This was an opportunity to perhaps branch out. And I think I heard Dennis talk about that, John, of like branching outside of just Northern Virginia and getting loans nationwide. And I think that trend that Sona took part in was pretty common with a lot of these smaller institutions kind of lending nationwide in places that they typically would not lend money before. The next thing I'll show here is some of the insights from a risk perspective. And let me just clear out some of this filter here. But from a risk perspective, one of the things we try to do is, Stephen talked about this concept of risk DNA, this risk scoring, looking at predictors that might be associated to some kind of financial crime risk, whether it's fraud or money laundering or what have you. And we tried to kind of take some of those risk DNA elements. Now, we were very limited on the data points that we could use for that and apply that to this open source data. And as you can see here, kind of looking at the corpus of the data, the average risk DNA score was around 47, and this is out of a scale of 100. And follows kind of a typical bell curve of that you would imagine, most of them kind of spiking here around the mid 40s, and then we had some kind of ranging up here in the 70 plus, which we would argue as kind of being the higher risk, from an inherent PPP risk perspective. And what makes something inherently high PPP risk? What we saw, and from our experience, is the type of business. So looking at the NAICS code, looking at if we were to drill into perhaps some of this kind of highest level of the 92s here, which is really kind of, as you see, if you can see in that kind of small pie chart, it's really that small segment. A lot of these were kind of businesses that had abstract type of NAICS codes. So they were in like the general management consulting or, imports, exports, or, things that were harder, to quantify, what they did. And a lot of, the tip-offs were they didn't have websites, and the websites, if they did have a website, it looked like it was built yesterday, and, it was not a lot of credible information there. And so that was just an example of one of the things that we pulled out here. But this tool has been helpful for us. One of the things that we've tried to do is walk through specific institutions. So institutions that we work with, we can, pick one here and drill into, okay, this bank issued 12 loans, looks like mostly here in Texas. What was their kind of inherent risk that we saw, from a risk perspective? It looks like a lot of high risk ones with this institution, but really kind of this is something we've been able to do is show your institution, this is what we see, applying some high level statistics, but certainly you can focus your due diligence on that high risk segment, or you can apply the kind of the due diligence across, focus due diligence across all of the PPP loans. And so, I'll probably leave it with that. I would, offer out anyone who's watching this webinar, whether live or recorded, this is something that we have access to and are happy to share, those insights about your institution, when and if you're interested.
Thank you, Quinn. All right, so we're moving on now to questions. And I do have a few questions that I would like to ask to our panel. All right, the first question is generally to everybody on the panel is what can compliance departments do to ensure that financial crimes compliance requirements are met and then the risks mitigated in relation to the forgiveness? So of course we've gone through the application process, the money's been dispersed, and now we are into the forgiveness period where banks have to review those forgiveness applications and then pass them off to the federal government. So how can we ensure continued compliance through that process? John, maybe you can take this.
Yeah, one of the first things I would do and recommend everybody does is go to the SBA website. They have a lot of information on the forgiveness program. It's evolving, just like the regular program did. I think they came out with something just recently, a streamlined process for loans under $50,000. So it's a good website. They've got some frequently asked questions. And I guess really from a strict compliance risk management framework, I mean, if you're an insured bank, you need to have a strong risk management framework. And I think you just need to do what you've always been doing and demonstrate to somebody coming in that, we took reasonable steps to prevent and detect anything, bad actors. And I think you're going to be okay.
And Tiffany, just to add to that, I would, I would kind of echo the point of what John just said in terms of, and I would qualify that too. I mean, not to presume too much, but if you have an adequate due diligence program, follow your due diligence program and process. If you didn't, in order to get loans out quickly, go back and do some form of double check or review. And get the due diligence up to where it needs to be, because then you'll find that you have a lot of the requirements fulfilled. And then there's just some specificity too, as it relates to what are the requirements associated with those forgiveness applications, things like documents verifying the number of full-time equivalent employees, that are retained, there's the retention requirements, et cetera. So, going through that list of and obtaining and making sure you have, in addition to that, from a BSA perspective, the payroll reports, payroll tax filings, income payroll, I mean, any of that stuff, as well as documents verifying the eligible interest related to, other expenses such as rent, utility payments.
I would just add to everything, it's a classic story of having kind of a risk-based approach. I think if there's one thing that we've seen and one takeaway is that there was some risk here. There was some risk in the way that PPP was rolled out. There's a lot of fraud that we've seen. And so, the approach to due diligence needs to be in line with that as well.
Okay, I'd also like to ask another question. What has been the biggest takeaway from managing this emergency relief program from a compliance perspective, and how can financial institutions take that into the future when we start to see more of these novel emergency types of programs come in?
Okay, I'll take that one, Tiffany. Nothing like a crisis to really an actual stress test of what your programs and processes are. This was helpful to us. You know, we have all sorts of risk management practices in place. We do all sorts of stress testing, shock testing, things of that nature. And this has really helped us to see, you know, where do we need to improve on? Mentioned earlier, some of the, Stephen was talking about, or maybe it was Quinn, about the risk scores that you all were coming up with. And we score all our customers. So that's one of the things we've been doing now, comparing the risk scores and to see if there's any significant changes to look and see where, you know, what might we have done a little different? Maybe we might have missed something. How can we enhance our process? It's been very beneficial from that perspective.
Yeah, just to echo that, I think there's a lot to be learned from your due diligence processes as it relates to this program. Because again, like I said earlier, regulatory agencies are interested naturally. I mean, it's the government's money, you know, and they care definitely about, you know, this program not being, you know, taken advantage of, which we know it happens. But just back to that original earlier commentary around, you know, take the opportunity to study, you know, the process and what you were able to do from a due diligence perspective as it relates to this program and how it may have called out inadequacies, and then apply those learnings, you know, rather quickly.
All right, and I have one more question on the line. Oh, go ahead, Quinn.
I was just going to say, you know, I think things like this come in waves, and there's multiple waves typically. There's the initial wave that, you know, are in how ready are you for that wave when it comes of kind of doing the initial due diligence. Then there's going to be a wave of regulatory kind of scrutiny against it. I will say there's something really important that I think we haven't addressed today, and that is, you know, we've talked about the initial risk of fraud in this loan portfolio. What we have not talked about is kind of the next huge wave or tsunami of, you know, if there's a 3% fraud rate on these funds, and there's a million of these PPP loans, and you know how many billions of dollars went out. If there's 3% of that is fraudulent, and I would argue there's probably a little bit more, that is a lot of bad money that is now floating out there. It's a lot of, you know, you can think about this, the application and the getting the loan as now the predicate offense, right? The fraud has been committed. We've caught some of them. We haven't caught a lot of the others. But now that money is in the system, and all the banks, whether you have participated in the PPP loans or not, now that money is in our U.S. financial institute system, and it's floating around. So what are you doing from a monitoring perspective, from a transaction monitoring perspective, from a due diligence? Where did, you know, source of funds when you're onboarding customers? We got to find that money, you know, and make sure that, you know, it came to the customers in a good way, and not from one of these fraudulent PPP loans that shouldn't have gotten to them in the first place.
Okay, I'd like to thank all of our panelists. I'm going to reserve that question and I'll answer it just directly later on because we are out of time. But in closing, thank you to everybody that came and listened today, as well as our panelists. We would love to be able to help you out, gain additional insights about these PPP loans and similar programs as they come out. We also would love to be able to help with any KYC initiatives and so on and so forth, as Stephen discussed some of the things that Risk Canvas Genpact does. So up here on this slide, we have Quinn's and Stephen's contact information. Feel free to reach out there or to any of us on LinkedIn as well. Thank you again, everybody.
Thanks, everybody. And Tiffany, are you going to close this out with Lurking in the Deep, the Adele reprise?
I'm
Thanks,
fresh
everyone.
off my singing career, but I'll leave that to you.
All right.
Thanks,
Stephen,
everyone.
you.
All right, thanks,
Yeah.
guys. Bye.